I want to welcome you all for the third day of the 8th annual NSE-NYU conference on Indian capital markets. So we have an exciting program today. So one of the highlights is we have a keynote speech by Nouriel Roubini, my colleague. And Nouriel has promised to make predictions for 2021 global economic outlook. He's also going to talk about the current crisis. We also have two really outstanding papers. So the first paper is Saving Speculative Markets from the Speculators. Rama Seth, Copenhagen Business School, Vladimir Gatchev, Ajay Singh of University of Central Florida, and Professor Vishwanath of Shiv Nadar University. They're all co-authors. And we have Jay Ritter from University of Florida, who is going to discuss that paper. And the other paper, the sixth research paper that we featured in this conference, what explains geographical variation in corporate investment, a tale of colonial hangover. Very interesting paper by Nishant Watts and Shohini Kundu from University of Chicago. And we have Francesco D'Acunto from Boston College to discuss that paper. Okay, as you can see, it's an exciting program. We're going to start with the first paper. I think Rama Seth is going to present the paper. Rama, the floor is yours.
Thanks, Koz. Today I'm going to present some interesting insights we have gotten from our study on IPOs in India. We thank NSE and NYU for giving us this opportunity to share our findings. I'm very grateful to you, Koz, for preliminary comments, and to Jay Ritter for discussing our paper today. The job of regulators like the SEC is to get capital ethically to firms engaged in productive activities at the lowest cost possible. We use in this paper a natural experiment, a unique data set that we put together ourselves, and an interesting literature on lottery payoffs to examine consequences of well-meaning regulation. The motivation comes from IPOs, prices being uncertain, firms going public have a short history, and little public information. And this uncertainty in the price variability is especially so in the first days of trading, making for a very interesting study. There's a large and growing literature showing that these uncertain returns could be attractive to investors with a preference for lottery-type assets that deliver unusually high payoffs with low probability. And we think that such a preference would be associated with these stocks being priced at a premium, but earning relatively low returns thereafter. The findings in the literature raise an interesting question. What if price moves were restricted so that investors are not able to experience lottery-like payoffs? Well, then we would expect that investors with a preference for such payoffs will not demand these assets anymore. And the consequent lower asset prices will impact the firm's desire for equity sales. In response to high volatility and price movement observed on the first day of trading, SEBI, which is the Indian equivalent of the SEC, imposed on January 2012 predetermined price bans on IPO stocks for 10 days post-listing. Under these rules, daily returns are effectively bound within a plus minus 5% range for smaller IPOs that have proceeds below $35 million, and within plus minus 20% range for IPOs larger than that. And these bands, we must note here that they are relative to opening price, not relative to the offer price, as is in some exchanges. They also introduce a pre-auction window for trading in IPOs to aid price discovery. To visualize the effects of these price limits, here we have plotted the daily prices of 2 IPOs in our sample. In panel A is the one by Advanta in April 2007, when the prices of IPO stock were not constrained by price bands. And the second one in the lower panel was by Cochin in August of 2017, when the price bands were in effect. You can see here that the stock price of the first IPO is unconstrained throughout the day. But the price of the second IPO reaches its 20% price limit very early in the trading day and limits further price movement. We use this illustration for formulating our first hypothesis, but first, let me talk about our main contributions. The early literature that originated from Friedman and Savage and Markowitz in late 40s and early 50s is concerned with individual attitudes towards gambling. And in the paper, we provide direct evidence of how changes in the distributional properties of stock returns affect investor demand and trading behavior. We also contribute to prior research examining the effects of investor sentiment on the demand and pricing of IPO stocks, such as by Darian and Green and Huang in 2012. Our paper also contributes to the literature examining the activity of primary equity markets, where several studies propose that firms prefer to go public when investor sentiment and optimism are high, such as the one done by Ritter and more recently by Santos in 2017. Our study also extends a strand of literature that examines the ability of financial regulators to curb speculation by imposing price limits, like Kim and Rhee have pointed out. We explore the relevance of price limits for newly listed IPO stocks and provide a different perspective from the one offered in prior literature, which has typically focused on the general population of stocks. Let me give you a preview of the main findings. We find several significant differences in the post-price band regime versus the pre-regulation era. And let me list them first. Post-regulation, relative to pre-reg, we find a pronounced decline in price variability for IPOs on their first day of trading. Also, post-reg IPO stocks provide a significantly lower upside potential relative to those in the pre-reg period. When we examine buying and selling activities of different investor types on the first day of trading, what we find is a significant drop in net buying by retail investors after the new regulations take effect. Now, we don't find a discernible difference in IPO first day returns between the two regimes, but we do find significant evidence of higher expected returns, thus lower market prices post-reg compared to the pre-reg. Lastly, we document a sharp decline in IPOs raising less than 2.5 billion rupees and listing on the main exchanges. And these are the very type of IPOs that are most affected by these new rules. When we look at the pre-market auction, we find that retail investors use it to sell, but institutional investors use it to buy shares. A few words on the data, as it is so unique. It's put together from various sources. The starting sample contains 431 IPOs listed between 2006 and 2017 on the main Indian exchanges, that is the NSE, National Stock Exchange, and the Bombay Stock Exchange. And we obtained this sample, or rather the universe, from Prime database, which is a private agency providing quite comprehensive data. And to ensure that the price mechanism is consistent across the sample, the majority of our analysis is focused only on the book-built IPOs, and we ignore the few others. But for part of our analysis, we also examine IPOs listed on the SME, or the Small and Medium Enterprises Exchange, and this was between 2012 and 2017. Prime database also provides information for several key IPO characteristics. Upon our request, the BSE did a special pull for us and provided us detailed information on each trade for the first day of trading, as well as the pre-market auction. Finally, we use the Prowess database, as is very common for firm characteristics, and we also use it for daily returns for the post-IPO month. Our empirical approach relies on comparing several key variables related to price variability, investor demand, investor trading activity, and asset prices for IPOs conducted in the pre-reg period and those conducted in the post-reg period. To control for other confounding effects, such as the types of firms going public in the two periods, we use propensity score matching, which we implement in two stages. In the first stage, we estimate a probit regression, where the dependent variable is whether the IPO was conducted in the post-regulation period. To create and match samples of treated and controlled post-reg and pre-reg IPOs, we use the estimated propensity scores to identify the closest match. I won't go into in much detail, but you can see that we get a very good match. We get a sample of 87 well-matched IPOs. And the firms are very comparable in many different characteristics. Only the size is somewhat smaller in the post-reg period. But I want to note here that using smaller firms should only bias our findings against finding the hypothesized differences between pre-reg and post-reg IPOs. We conduct a whole bunch of robustness tests while we only present the findings based on the closest match, and we can provide these tests upon request. We test the validity of hypothesis 1 by first examining the variability of IPO stock prices on the first day of trading. Were the new regulations restrictive enough to materially affect the price movements of stocks? For example, if the imposed price bands are sufficiently wide so that the majority of IPO stocks experience price variations that are well within the price bands, the effects of new regulation may be negligible. Our results provide strong support for the hypothesis, which states that the new regs had a significant effect on dampening the price variability of IPO stocks on the first day of trading. And this reduction in price movements should significantly limit investor opportunities to capture those high returns on the first day of trading. I'll jump over some of the results, but you can observe the steep drop in daily high prices relative to the open prices here in the left panel, and the clear decline in the upward price. It moves. You can see that the new rules indeed imposed significant restrictions on the price variability of IPO stocks in the left panel here. I'll skip over this. And for the second hypothesis, we do find support and show a statistically significant decline in the subscription rate of retail investors, for which the time to subscribe ratio drops from around 9 in the pre-reg to approximately only 4.7 post-reg. And we also see a significant decline in the subscription rate of qualified institutional investors. The only investors that we see a rise in is for high net worth individuals that show an increased demand from 49 times the share originally allotted to them to 75 times the shares. In the IPO aftermarket on the first day of trading, there's less buying by retail investors in periods when the price bands are in effect, and we find strong support for this as well. This table shows a strong support which suggests net selling by retail investors in the post-reg period. Now, we compared underpricing but did not find significant differences in IPO underpricing between the two periods. But we find strong support for the hypothesis that market prices will be lower and subsequent returns higher of freshly listed IPO stocks in periods when the price bands are in effect. A reduction in speculative demand and in speculative net buying post-reg has led to the reduction in prices of IPO stocks and an increase in their expected returns. Here you can see in our seemingly related regressions that IPO stocks in the pre-reg period have a monthly alpha of around negative 1.2%, and this underperformance changes to a monthly alpha of around 1.5% post-reg, and this finding is consistent with an increase in expected returns post-reg. The new rules provided for stricter restrictions for smaller IPOs. Their prices were allowed to vary, as I said, only within a plus minus percentage range and 5% range. You would expect then that the percent of all IPOs raising proceeds below 2.5 billion rupees to drop, which they indeed did, as you can see in this graph, from 70 to 20% approximately. The details of the change in the IPOs you can see if you're interested. I've provided them in the reference slide 46. I'll just spend, I think I have 2 more minutes. I'll spend a minute talking about the kernel densities that are plotted here of IPO proceeds for 3 subsamples. The first subsample, which is the solid line, contains all the IPOs between 2006 and 2011 listed on the main exchange. The second dashed line shows the subsample between 2012 and 2017 listed on the main exchange. And the third red subsample contains all IPOs between 2012 and 2017 listed on the SME exchange. And we include both book-build and fixed-price IPOs in this part of the analysis to look at a comprehensive set of firms. You can see very clearly here that in post-reg, there's a sharp decline in the mid-size IPOs, those raising less than 2.5 billion rupees and listed on the main exchanges. And this finding is consistent with hypothesis 5. Of even greater interest is how few medium-sized IPOs were listed on all exchanges. But we find a very active market for the small IPOs. With 327 IPOs, the SME exchange was very active over that period. And we find that all these IPOs raised less than 2.5 billion rupees. So there's no shortage, apparently, of relatively smaller firms willing to go public. But it's curious that the disappearance of medium-sized IPOs, what happens to those? It could perhaps be explained by such firms facing significantly reduced valuations, whether they list on the main exchanges or on the SME exchange. And as a result, they may have chosen to just remain private. So let me summarize then our main conclusions. Post-reg relative to the pre-reg, we find a pronounced decline in price variability for IPO stocks on their first day of trading. Moreover, post-reg IPOs stocks provide a significantly lower upside potential relative to the pre-reg. We also find that the retail demand for IPO stocks measured by the subscription rates of retail investors declines significantly. Now, we don't find a discernible difference in IPO first day returns between the two regimes, but we do find significant evidence of higher expected returns and thus lower market prices post-reg. We document a sharp decline in IPOs raising less than $35 million and listing on the main exchanges. And these are the very types of IPOs that I pointed out are most affected by the new rules. We think that the new rules on the main exchanges led them to disappear there, but these stocks are not being picked up by the SME, and it's a mystery a little bit where they are. So to end, we think the regulations did have a discernible downside, and that's the reduced participation of speculative investors may have significantly increased the firm's cost of capital and possibly reduced firm incentives to sell their equity to public investors. Thank you.
Thank you, Rama. Very interesting paper. But what I say doesn't matter. Let's see what Jay has to say. So the discussant is Jay Ritter from University of Florida. Jay, the floor is yours.
This is a very interesting and nice paper. This paper is mainly dealing with skewness preference in the context of the IPO market in India. And it shows that there's an effect, as she mentioned. In 2012, daily price limits were imposed for the first 10 days of trading. And there are other countries that have daily price limits, but India, to the best of my knowledge, is unique in terms of, for the first day, the price limit isn't measured from the offer price, it's measured from the opening price. In other countries where there's a limit from the offer price, for instance, China, since 2014, has limited the first day increase for most IPOs to 44%. There's been extreme underpricing in China, and so that 44% limit is binding for almost all IPOs until recently, when they've relaxed the constraints for some IPOs. In Indonesia, the limit on the first day depends upon how big the offering is. But with the SEBI limits, as was pointed out, it applies once the stock has started trading. And it seems to have had an effect of reducing speculative demand. The paper hypothesizes that these price limits reduce the demand from retail investors who like right skewness. Okay, now, the assumption in the paper is that some, but not all, investors want right skewness. And this is a standard assumption in the literature. There are some investors that care about the long run, and they want to maximize returns and minimize variance, and they don't care about getting lottery-like payoffs on individual securities, but some investors might. So a question in this literature is always, is this clientele of investors who want the lottery-like payoffs, is it big enough to affect market prices? And one possibility in the IPO market is there are some IPOs where the skewness preferring investors dominate the market. There are so many of them that they push up the prices, and others that, big IPOs where institutional investors might dominate the pricing, where the prices aren't affected by those speculative investors. But it's an empirical question. Even for the bigger IPOs, there might be so much retail demand for these that it might push up the price. So one possible equilibrium is the assets, IPOs, with these right-skewed distributions have the price pushed up, and that results in low long-run returns. Other assets might not be affected by this. Well, in their empirical work, they present some descriptive statistics. One thing that I noted is in their table 1, the mean debt ratio measured as total liabilities to assets averages 84% for the main board IPOs. And their numbers, given that the median is only 41%, imply that some of the IPOs have total liabilities exceeding assets. The sample is also older than the typical IPO in the United States. The median age is 23 years, which is about twice as high as for IPOs in the United States. Some of the other things they point out are that venture capital-backed IPOs are a smaller portion of their sample. The U.S. does not have any equivalent of the SME board. There's no prohibition on really tiny IPOs in the U.S., but in practice, none of them that get listed on NASDAQ or the New York Stock Exchange are as small as the SME IPOs. There might be a few of them that go public OTC, but they're largely ignored. In the paper, they report the kernel densities. For those who aren't statistical experts, I had to look up just what a kernel density was. I had forgotten. It's a smooth density. They take the empirical distribution and then smooth it so that it's not real bouncy. And as this graph from the paper shows, the wider distribution is before regulation limited those price limits. The tighter distribution that's more peaked is after the price limits. But this smoothing procedure might hide the minus 20% and plus 20% situations where this limit was binding for that intraday return. I don't think it's a huge part of the sample, but it would be interesting to see just how frequent it is that within the first day of trading, that 20% boundary gets hit, and then trading volume collapses because nobody wants to buy or sell at a price that's being constrained. Now, they report that for the main board IPOs, before regulation changes, the average first-day return was 19.5%, and then it dropped to 12.5%, although those numbers are not statistically different from each other. And I was surprised how low these numbers are, given the subscription ratios of 29 before and 19 after. So there's a lot of demand, but there's not extreme underpricing. In a lot of other countries where there's extreme demand, there's more underpricing. Now, in India and China, they call the procedure for pricing and allocating most IPOs book building, but it's really not book building, because with book building, the underwriters negotiate with the issuing firm and decide on the offer price. And crucially, the underwriters have discretion to allocate shares to investors if there's excess demand. And that creates a possible conflict of interest, where underwriters might then want to underprice the IPO, recommend a low offer price, and then allocate underpriced shares to their hedge fund clients who are really profitable customers. And so there's this conflict of interest between the issuing company that wants to get a higher offer price and the underwriter that wants to leave more money on the table. In India, where underwriters don't have this discretion, it results in less underpricing because that conflict of interest is largely eliminated. So my view is that the SEBI has really good regulations in this regard. The IPO market works better in India in this regard than it does in the United States. Yesterday, a company went public, DoorDash, raised $3.3 billion and left 2.5 billion US dollars on the table. Like 150 billion rupees were left on the table. That's money that's not on the company's balance sheet because of that severe underpricing. Airbnb today is going public in a large IPO as well, and it's quite possible they're going to leave a lot of money on the table as well. The conflict of interest with underwriters wanting to leave money on the table and getting away with it is pretty severe in the United States. So my view is, partly due to the regulatory environment, IPO pricing in India works better than in the vast majority of countries in the world. Now, they're emphasizing the speculative demand from investors who want right-skewe distributions. But even if there are these daily price limits, in the long run, for IPOs and other stocks, the distribution is still right-skewed. So implicitly, they've got a joint hypothesis that these speculators care about right-skewness, and they've got a short horizon. They care about the daily return rather than a longer horizon return. And theoretically, you do have day traders who care about what's happening today, and you've got other investors who want to buy lottery tickets, but they're not worried about what happens today as long as that lottery ticket pays off in the longer run. Now, in the U.S. and in India and in most countries, the smaller IPOs have more right skewness, and they've also got lower average returns. So maybe it is the case that in both India and the US and in most countries, for the smallest company IPOs, you've got individual investors pushing up the price to above competitive levels because of this demand for the lottery tickets. And it results in long-run returns that are much lower than they could get if they had bought bigger IPOs or bought the general stock market in general. Now, this paper is focusing on the before and after analysis from the regulatory change, but it could also look at the cross-sectional pattern of the long-run returns and short-run returns on the SME IPOs relative to the main board IPOs. So that would be my main suggestion for a potential extension of the paper. I guess I'm summarizing it at this point. Overall, I like the paper. It makes a pretty convincing case that these price limits, the intraday price limits, have reduced speculative demand, and that seems to have reduced the price that investors are willing to pay on the first day of trading for these stocks. That results in higher long-run returns for investors, and presumably that's going to attract more buy and hold investors into the market to buy IPOs. Thank you.
Thank you, Jay. Thank you. We have now like 15 minutes for a general discussion of any of the issues. Rama, do you want to start by responding to Jay, and then please all the other authors pipe in and say their piece? Yeah.
We are really very grateful to Jay for your insightful comments. And I have to say that we especially thank you for taking the trouble to send us our paper back with detailed comments in addition to the discussion here. You've given us a lot of food for thought, so thank you. I do want to talk a little bit about a couple of things. You're correct in saying that other assets will have a different clientele of investors and higher returns. In fact, this point was made by Vlad a long time ago and somehow got lost. So thank you for bringing it up, and we can perhaps examine the subscription patterns and returns of SME IPOs and contrast the results with the main board IPOs. SEBI, yes, of course, imposes limits from the opening price, and it does not impose limit from offer to open. So you've correctly argued that underpricing need not be low, and that may explain why we don't find any support for 4B. We don't find a significant change in underpricing despite the controls and auction. Also, the auction results in improved price discovery and hence lower underpricing, and this could be, perhaps another explanation for our results. One last point is that you point out that some firms may have more liabilities than assets, and this could well be, and we'll definitely take another relook at the data set. So thank you very much, and I think maybe some of my co-authors may want to say some words.
Great. Ajay, your turn.
I just want to thank Jay and you, Chris. I think Vlad had a slide. Do you see the slide?
Yes, very well.
So after Jay sent us the comments yesterday, it's a really interesting question about the distribution of the actual distribution, not just the smoothed one, right? So we did this picture to just look at that, and we also broke them into less than 2.5 billion rupees and more than 2.5 billion. And so the solid line shows the smoothed kernel density, while the bars are just the frequency plot. It looks like what Jay's point is spot on, especially for the smaller ones, where we can see here how the 5% plus minus 5% price bands are being hit very often. So that's spot on. So we're going to investigate this more carefully in our next iteration to see what we can learn from that. For the bigger ones, it seems like the kernel densities do a pretty good job of describing the underlying distribution. But we'll also look at this one because clearly also there's a truncation at 20% and minus 20%. But that really gave us a really good idea to look at more carefully the smaller ones, even though they're a smaller sample. It may be something very, very, very worthwhile investigating. So, thanks a lot for the comments.
I don't find that surprising. A 5% plus or minus move is a pretty narrow band. So it's not surprising that for the smaller IPOs, they hit that boundary pretty frequently.
Absolutely.
Thank you, Vlad. Okay, any other questions, Rama? Do you have any comments while we are?
I just made my comments. I think for now I'm done.
Okay, great. Tirthankar, any comments that you're seeing in the panelists? So what we're going to do is to have a discussion among the panelists. Yeah, go ahead, please. Go ahead.
Well, Rama, you mentioned that this lower speculation element in your presentation actually ends up lowering incentives for companies to raise capital. Could you elaborate on that part?
No, I don't mean that it would lower incentives to raise capital. I just mean that the cost of capital has increased by these investors disappearing. So, it's a conjecture. It's one of the things Jay asked for is some economic conclusions and the so what of it. So I guess that's my so what. My take on the so what is that if we see a whole bunch of investors just disappearing, we are likely to see the cost of capital of these guys going up.
Is this a trade-off in from a policy implication perspective? Because what Jay said is one, you have very tight pricing in India. You have pricing that's better than probably any market in the world. On the other hand, you do have slightly higher cost of capital for companies trying to raise money because these speculative investors are down. Or should we see it from a policy implication?
Yeah, I think that's right.
We do have other questions.
Want to add to that?
Yeah.
Should I go ahead and ask?
Yes, please.
Rama, it's just not a question or a comment, it's just an observation. We have taken I'm not a strong believer in equity grading. I don't think even SEBI is a believer in that. But we took graded IPOs, and we found something interesting. So because your result made me think about it, that if the equity grade was higher, then the volatility on the IPO day, as measured by the Parkinson volatility, was significantly lower. The higher the equity grade, the lower was the Parkinson volatility. So I'm wondering if this equity grade was in some sense capturing what this price band thing without anyone realizing that. And we did find, of course, a difference in the volatility of those who had positive day zero return and negative day zero, that overall, that equity grading has an effect on day zero Parkinson volatility and significant. That was interesting, and that seems to tally with what you've just mentioned. So if any thoughts you can throw in?
I think that's a very interesting observation. We'll have to, I'll have to give it some more thought, but it's definitely a different perspective and worth thinking about. Thanks, Bunny.
Thank you, Rama. Thank you.
Rama, I have a question. This is actually related to Jay's point that he made. So here is the and that you made. So Jay was saying, because of whatever the collective regulation that you have in the Indian IPO market, the money left on the table by the firms basically is lower. So that, just looking at that argument, you would think that increases, that actually, because less money is left on the table, that reduces the cost of capital. Yeah. And then that's one part of the argument. That actually doesn't increase the cost of capital. That even though there is less participation, that reduces the cost of capital. Now, there is another argument people have made in the IPO setting, that is, yes, they might be leaving money on the table. However, in the long term, there is more information production about the firm, more analysts are following, there is more interest in the firm, which by itself would say what you say. That is, this might be actually leading to lower cost of capital. So I don't know. I think it's a very important question to tease out, which is the effect that is going to dominate from the effect that you're going to talk about.
I agree with you, Koz. The only thing is that Jay's point, I think, applies to the whole period. That basically our way of conducting IPOs allows less money on the table, period. I don't think it has to do so much with pre and post reg. Whereas the point I was making in terms of perhaps the cost of capital going up was a very sort of a tentative conjecture about one of the maybe unintended consequences of the reg. But I think there is the overall sort of overarching question that you have in mind is definitely very worthwhile to think about.
Yeah, this is Jay. Just to clarify, we're using kind of two different definitions of the cost of capital here. One of the costs of capital is if you get a high price with a low expected return, that percentage cost of capital is low. The other aspect is the transaction cost part of the cost of capital. And those transaction costs would be the investment banker fees and other direct costs, plus the money left on the table, the amount that the company doesn't get that investors were willing to pay. And in India, that middleman's take, the transaction costs are relatively low compared with many other countries. In terms of whether the price is too high, too low, affecting that rate of return, that's largely an issue of the company wants the low cost of capital. Investors want high returns. In a well-functioning capital market, those two things need to be balanced.
Jay, you seem, having looked at the IPO scene in India, do you have any kind of feeling whether the IPO markets are working in India to some degree or not?
Well, the IPO market is part of the overall market for financing businesses, including the banking system and everything else. Fundamentally, having profitable growing firms is the most important part for an economy and the country's standard of living and economic growth. But well-functioning capital markets, including the IPO market, help facilitate that economic growth. I'm not going to claim that I've got as much expertise on India's economy as most people, but I think the big criticism of India's economy is too much regulation of labor markets and poor infrastructure and other things like that need to be reformed.
Thank you.
Yeah, this is Vladimir. I wanted to just chime in on the comments. So I think that point that we would need to look at maybe a more balanced or more nuanced story is really well taken. I think that's something that we've put on our list to consider. And I think that's, the comments that you have made, both made, really point in that direction. So we'll take care of that going forward.
There is some evidence that managers, I think in India and outside, do earnings management to affect the cost of capital. But I don't think earnings management is something that is a part of your paper, right? So that could be partly explaining the cost of capital. Managers intentionally, proactively manage the earnings to influence the cost of capital.
Yes, but do you think, Bunny, that there is more of an incentive to do that in our markets than in say the US markets? I think that earnings management perhaps exists everywhere and perhaps more in the US markets.
I think there is some evidence that who the auditor could influence that. So if there are top auditing firms, they will not allow earnings management as much. So I think the auditing rules in the US and India are different. So India, there may be slightly more incentive for earnings management because of who the auditor is, and I think less fraction is audited by the top firms. So one of my students studying that, so I do not know what the evidence she has found, whether there is a less constraint in bluffing in India.
Right. Very interesting. I'd love to see the study once it's done.
Tirthankar, there are some questions.
Yes. There are two questions, very similar, but let me just read them out. The data sets are comparing time periods 2007 and 17, during which characteristics and nature of participants in the markets have changed dramatically. Institutional investors' share of market activity between 2017 has changed. And let me read the second question. Maybe you can answer both together. I understand that the IPOs were matched, but market sentiment in the pre-period 2007 to 12 was very pro-IPO, while the post-market, 2012 to 17, saw very few IPOs. Could that have any effect on return and investor pattern changes that you see?
Does anyone else want to feel that? I think the short answer is I don't know. We've tried to use controls to as much as possible try to control for confounding effects and other stuff, but it's possible that there is some residual effects that we haven't captured, but I don't think there's a way to clearly know that.
We'll definitely look into that possibility. We're thinking of kind of making slightly more careful analysis of IPOs that are especially using the cutoff points more carefully, because there was in the cross section, like actually Jay pointed to that as well. Look at the cross section more carefully, not just over time, and I think that may help us address some of these questions. It is possible that the desire for IPOs in general has disappeared in the Indian market. That I don't know though. If there's a study that has done this, that will be a great study to know and look at more carefully, and we'll look for it here.
Certainly, it's no longer the market that we saw 10 years back. I have, in the interest of time, I have another series of questions.
I just want to make a quick point there that I don't believe that the demand from what I would say a cursory cursory survey, that the demand for IPOs has gone down any. I think the mystery, and if anyone familiar with the markets, Tirthankar, you're included, can throw light, or Bani, you may know, what happened to that middle section. We see very high activity in the lower and the high IPOs still. So I don't think that shows any decline in investor interest. But what happened to that middle IPO section? I don't quite, we are not able to get a handle on that. So if anyone has insights on that, that would help. We would love to, anyone in the audience, even later, if you send us an email or whatever, we'd love to know your thoughts on that. Thanks.
I'll look at it.
We have a couple of questions from Madhu. Madhu, okay. If you could ask them direct, or I will read them. Your choice, Madhu.
Madhu, keep it short because we're running out of time.
Yeah.
I just emailed to Rama. That's much easier. No, I just wanted to give some space. Thank you.
Right.
Thank you.
Okay. Right, because then I'm just going to thank the authors and did a great job. And Jay, thank you so much for a wonderful discussion.
Thank you.
Thank you, guys. Thank you. Thank you all. We have a fantastic paper coming up. It's one of the research papers supported by the grant. What explains geographic variation in corporate investment? A Tale of Colonial Hangover, and the paper is by Nishant Watts and Shohini Kundu, who are at the University of Chicago. Nishant, the floor is yours.
Thank you, Koz, for the kind introduction. So this paper is called What Explains Geographic Variation in Investment, A Tale of Colonial Hangover. I am Nishant Watts, a PhD student at Chicago booth, and this is joint work with Shohini Kundu, who is also at the call, so you can throw all the difficult questions at her. So when we start, we want to start with a few facts. And the fact number one that we want to show to you is that investment is geographically concentrated. So how do we go about this? So what we know is we know the aggregate amount of corporate investment in each district. And for each state, we can identify the Herfindahl index, which sort of measures how well investment is concentrated within states. So the blue line and the red line that you see over here is sort of a weighted average and a simple average, respectively, of this Herfindahl index for each year. And now these Herfindahl index don't mean anything in itself, so you need to compare them to a benchmark. So we have three benchmarks over here, which is one is the triangle line, which is the number of HHI, where the HHI is simply assumed to be equal to 1 by n, where n is the number of districts in the state. The orange or the hollow circles are the population HHI, where we assume that the investment should have been proportional to the share of population in that district respective to the state. And the last, which is the cross line, is the area HHI, where we assume that the investment should have been proportional to the share of the area of the district related to the state. So these three benchmarks are supposed to give us an idea how would the investment concentration would look like in a frictionless spatial equilibrium. However, in the data, the concentration is way higher than what you would expect in a frictionless spatial equilibrium. So that was fact number one. Next, you can do some simple algebra and sort of decompose this HHI using the fact that all corporate investment in India is either coming from government-owned firms or non-government-owned firms. So you can decompose HHI into coming from government, private, and this cross term which comes because of squaring of the share to compute the HHI. And then you can actually look at the data and try to decompose each of these components. So in the table, column number 1 gives you the total HHI, where the median and the mean values are quite high relative to the benchmark. The column 2, 3, and 4 give you the concentration coming from government, private, and the cross term. And if you look at the cross term, it's actually quite small relative to what we have at the total. And the private guys are actually quite close to the benchmark. Whereas when you look at the government, it is almost twice that of the benchmark. So this is to basically document fact number 2, that the geographic concentration that we saw in the aggregate data before was sort of driven by these government-owned firms. So given these two facts, the research question that we are interested in this paper is, what explains the geographic concentration of investment? If you want to go down much deeper into the specifics, specifically we are asking, what is the friction that makes these state-owned organizations, SOEs, geographically concentrate their investment? And if you look at the literature on agglomeration or concentration, it has primarily taken from Ed Glaser's original GPE paper, where people have tried to use the factors of production, such as the Marshallian forces or geographic advantage at play, to explain these kind of concentration phenomena. In this paper, we take a step back from that literature and say, wait, factors of production of course matter, but what we are going to focus in this paper are the rules of the game under which these factors of production operate. And the literature in that sense is often focused on initial conditions, specifically extractive colonial institutions. But of course, extractive colonial institutions were not the starting of the world. There was a world before that. Of course, we don't go all the way back to Big Bang. What we are trying to look at is what was the polity structure in these places before the colonization happened. Specifically, we're going to talk about the crucial role played by the pre-colonial local elites. So you can think of them as kings or princes or very big landed castes. So what is the framework we have in mind? So when we think about the extractive colonial institutions kind of literature, we think that so there's a long-term persistence hypothesis that extractive colonial institutions persist to create extractive current institutions, and because of which the politicians get an advantage to pocket more money. In this paper, we're actually going to give you a different angle to it. We're going to argue that there are these pre-colonial elites, and these elites can sort of exert either countervailing or exacerbating effects, even when colonial institutions are very extractive. And the effect of pre-colonial elites will depend on two factors. One, how much of post-colonial power they have. That will determine the magnitude of the effect. So think about elites who have no power. So even if they have the best of the interest of yours and mine, they cannot do anything. So that is going to determine the magnitude of the effect. And then they will have these incentives and motivations which the direction of the effect. So you can think of these elites as being, so in some cases you can think of these elites as being these perverse agents who want to just steal, in which case they will actually exploit these extractive institutions more and will actually increase the extractiveness of these institutions. On the other hand, these elites are often guided by these legacy issues because their forefathers and grandfathers have taken care of the subjects. So they have these legacy issues to take care of, which can sort of exert positive effect. So before I give you a preview of the result, I just want to give you a quick snapshot of the historical setting that we have in mind. So think about the pre-colonial India. So we have kings, we have the kings and the princes who are ruling different areas. And then we have the British rule. And the way the British rule happened in India was either via indirect rule, where the Britishers says, okay, the kings can administer the local areas, but the right to have military and the right to manage revenue will be with us. So that will be indirect rule. And then you have the direct rule, where the Britishers says we are going to take the direct rule. We are directly going to administer these areas. And this was a topic of Lakshmi Iyer's 2010 Aristat paper, where she talks about how direct rule areas are basically sort of a proxy for low institutional quality. In this paper, what we're going to talk about is a very new setting, which is basically we're going to look at direct rule itself. And direct rule is not a homogeneous quantity. They were acquired during different periods of times, and they were things that were happening in Europe at that time. And we're going to argue that things that were happening in Europe at that time influenced the way these Britishers were annexing India at that time. So we basically split the annexation time into two periods. One is the period of European war. So these refer to periods of annexation in local India, while England was at war in the Europe. So think about the Crimean War, where they were at war with the Russian and also partly with the French. So these are the European wars which are happening all the way back in Europe and have nothing to do with India. So there were these districts which were acquired during periods of European war, and these districts, and in these districts, the pre-colonial elites were very aggressively deposed. And the reason cited for this strong deposition was because of a centralized directive that came from the British Parliament, where they said that where they were too scared of any kind of subsequent revolt. So they said, whenever we are at war, you're going to just destroy all the elites to diminish any probability of a revolt. Whereas this thing did not happen during periods of European peace. Okay, so now given that we have some idea of the setting, we can actually give you a preview of the results. So in this paper, we use India as a laboratory, where we combine spatial differences in extractive colonial institutions, which are coming from differences in direct and indirect rule, and then deposition of pre-colonial elites in direct ruled areas, which is basically we're going to call them as war and peace. So these refers to periods of war in the Europe involving Britain. And the result that we're going to show you is this, that so there was this sort of concentration away from certain districts and states, and we're going to argue that investment is actually lower in areas that were directly ruled by British. Then we're going to dig deep and say that, okay, it's not only about extractive colonial institution, but there is also heterogeneity in investment levels within direct rule areas, depending on whether the areas were annexed during periods of European war or European peace. And more importantly, this entire phenomena of lower investment is driven by SOEs. And in terms of mechanism, we will try to convince you it's because there are these extractive colonial institutions which determine spatial differences in ability of politicians to expropriate. And what happens is these pre-colonial elites can impede the ability of politicians to expropriate. So just to give an idea of the data that we have comes from CMI Apex. The span that we use is 1995 to 2018. We have quite a good geographic coverage of the data. So this slide sort of gives a brief description of how the colonial boundaries look like. So panel A over here basically gives you a visual description of how the direct and the indirect rules look like. And panel B over here basically shows you within the direct rule, how did the war and peace differentiation look like. So what it shows you that there is actually a great amount of heterogeneity, especially spatial heterogeneity, which we can be exploited to explain the question at hand. So we want to first start by replicating Lakshmi Iyer's result. We want to show that investment is indeed lower in areas with extractive colonial institutions. And for this, we run a collapse specification. So we run a regression of investment at district level, district area level, on whether the district was historically under direct rule or not. And what we find in the underlying table is that consistently the coefficient on direct rule is negative. And if you want to think about these magnitudes, you can think of them as projects are 25% less likely to be announced in direct ruled areas related to indirect ruled areas within a state. And comparison within a state is very important over here, because you really want to control for the rule of the law in the land, and because states can also make their own laws in India, we want to really look at within a state itself. And if you want to look at the amount of aggregate investment, so aggregate investment in direct ruled areas is lower by the amount of $220 million. Okay, now we can move on to our elite story, and there are some clarifying points that I would want to note over here. So as pointed out that so while direct rule areas had these quote unquote extractive colonial institutions, there was some heterogeneity within the direct rule areas based on whether these territories were annexed during periods of European war or European peace. And this was sort of a centralized policy which came from the British Parliament to avoid revolts in colonies during periods of European war. And we verify that post-independence, these elites retain a substantial amount of economic power. So this is, you can think of this as like a stage zero in the background, which is happening. So over here, we look at the wealth of the landed elites in column 1. Column 2, we look at the wealth of the ruling elites. And all this comparison is happening within a district. So within a district, we're comparing ruling class versus non-ruling class. And what we find is that in war districts, the difference is actually lower. So that is to say that these elites retained a substantial amount of power if they were actually annexed during periods of European peace relative to being annexed during periods of European war. So having done extensive work with the setting, now we want to think about the kind of specification we want to estimate. And over here, we want to regress the natural logarithm of project size, where project size is the project announced by firm F in district D at time T. And then we want to regress this object on a cross term of war, whether the district D was annexed during times of European war or not, or whether it was annexed during times of European peace. And we interact this with an indicator of state-owned enterprises, which is a firm level indicator indicating whether the firm is state-owned or not. While doing that, we want to control for district year fixed effects. So district year fixed effect basically takes care of the Ed Lesser story. So it basically tries to absorb all the geographic advantage and all the Marshallian forces which are available at the district level. So now what is left out of this interaction term is basically trying to capture the rules of the game under which these factors of productions are operating. We also control for the firm year fixed effects, which are basically sought to control for the aggregate supply of investment coming from the firm level. And the way we are estimating standard errors over here are basically by two-way clustering by historical state and time. So just to talk a bit about the identification over here. So the identification assumption that we have over here is that the timing of international conflicts involving British is uncorrelated with the timing of local British annexation in India. And put simply, that is to say that if there is a war between Britishers and the local ruler in India, the timing of that war is not related with the timing of international conflicts in Europe, which is involving the British. And why do we think of this as a reasonable assumption? We think that there are three reasons why this would be a reasonable assumption. First, if you look at the amount of time the British East India Company was at war in India, given the amount of times Europe was at war or peace, so almost half of these times the British East India Company was at war. So there was no. So if you look at just the aggregate timing, there was no selection that they want to fight more or less during certain periods. Then we look at the 1913 India census, and we try to look at if there are any differences across some observables. So for example, we look at some of the observable related to industry, like whether there's cotton, silk, spices, the kind of rulers, whether you're Maratha ruler, Muslim ruler. We look at the population, and what we find is consistently that none of these observables can explain. Moreover, what we also look at, and because these are basically annexation, you might also be concerned about the military spending. And then we look at the time series of military, non-military, and land review collection coming from these two regions. And what we find again is that there's no economically meaningful difference between war and peace districts when you think about military, non-military, or land revenue system. So this is to say, basically, if you look at the most obvious observables and try to figure out if there are any differences between these war and peace districts, there seems to be none. And if you're still not convinced, what we do more is we go deep into data. We do a narrative analysis where we try and look at why the British annexed the territories they annexed. And when we look at the records of the historians trying to explain why certain districts were annexed, we cannot find any where the historians are actively talking about the wars in Europe involving British, which can justify the timing of the expansion of British Empire in India. So we look at step-by-step expansion of the British Empire, and what we see is more as an obvious growth kind of what we see, I can see as an obvious growth kind of thing is that, say, if Britishers have annexed a territory, the next annexation happens more likely in the periphery of the territory. Of course, there are certain examples, like the example coming from the Surat or over here, where the new boundaries do not match with the existing boundaries. And in those cases, again, we go to the historical records. For example, in this case, I can tell you Tipu Sultan annexed a ruler. The ruler went to the Britishers for help, and that's why the Britishers annexed. So we have done a systematic analysis of all these annexation, and again, we cannot find any substantial reason where historians strongly believe that the reason for annexation or the timing of the annexation was related to the timing of European war. So all this is to say that this assumption which we have, which is an important identification assumption, where we want to argue that our results are not really driven by these observables and unobservables. And now, having established the baseline specification and the identification condition, what we show you is the baseline result. So column 1 is sort of replicating the result that you saw before, where the investment in direct rule was negative. Column 2 splits direct rule in war and peace. So over here, if you see that there is not much of a difference, so there is only very little difference between war and peace districts. In column number 3, when we interact war with state-owned enterprises, then the difference between the terms becomes enormous. And column number 4, which is basically our preferred specification, we see that there is a difference of 10 percentage point in terms of investment growth. And column number 5 splits these state-owned enterprises by whether these are governed by the federal government or whether they are governed by the local meaning the state government. And we see that the majority of the difference between war and peace, so if you look at the coefficient of war times local and peace times local, the majority of the difference is actually coming from the local state-owned enterprises. And we do a rigorous set of analysis to make sure that these results that we are capturing is very robust. So we control for the land tenure system, which is a focus of the Banerjee and Nair paper. We control for the geographic factors interacted with the state-owned enterprises, as well as distance from capital, which Ilyas has spoken about in his work as being an important determinant of state investment. We also try to control for mode of annexation. And one more test that we do is we actually look at the sample of very bordering districts. And again, in these samples of very bordering districts, we find a very similar result. The motivation for doing the bordering district analysis goes like this: that while we argue that the result is unlikely to be driven by any observables and unobservables, so even if you assume that there are still differences in observables and unobservables, as long as these differences are likely to be smooth across these small boundaries, we can assume that our identification assumption holds. This is to think about what are the exact mechanics, how this is happening. So we can think about that politician can steal in 2 ways. So one way he can steal is through direct stealing, where SOEs announce a project and he steals directly from those projects. Or second one is that he can steal through bribery. That is, he can take bribe from private firms in lieu of granting them favors while they invest in politicians' territory. The way we think about direct stealing is that it is easier to detect. We have technology like RTI, these CVC audits, which make it easier to detect direct stealing. Whereas bribery is something we think of as very hard to detect. And moreover, importantly, the technology to detect bribery needs to be local and cannot be a centralized technology. Moreover, we know that there is a trade-off between the investment of state-owned enterprises and private investment, in the sense that state-owned enterprises investment crowds out private investment. And also, we know that when state-owned enterprises enter a market, they usually raise the household income, which makes labor costly for these private firms. So these 2 points are to say that basically from a politician's perspective, direct stealing and bribes are sort of substitutes. And because of the reduced probability in detection of bribes, a politician prefers bribes. And of course, then there are these local institutions which makes it easier for him or her to take bribes. And then there are these pre-colonial elites who have some sort of social capital which allows them to detect bribes, and hence they are able to check these politicians. Alternatively, you can also think about these politicians as owning the economic capital, which is primarily land, and they want to maximize the returns to land, which which are more suited to them when an SOE investment comes in. So an important point of our mechanism hinges on politicians being more corrupt. And now to basically support that argument, we provide some ex post corruption examples. So what we do over here is we look at winner's premium, which was first introduced in the literature by Snyder and then more recently worked on by Ray Fisman, Schulz, and Vikrant Vig. So over here, we look at how much is the growth of assets of winner versus the runner-up. When we say the runner-up, we're talking about the guy who just came second. So they're like very close. They are like very comparable to each other. And we look at between two elections, what is the asset growth? And we find systematically that there is on aggregate a winner's premium of the magnitude of 3.4%, which is very consistent with the literature. Importantly is that when we dissect this winner's premium, the majority of this winner premiums of the magnitude of 5%, which is twice as much as what you would see in indirect rule and peace, is coming for ward districts. So this result is to show that this result basically builds upon this opinion of political economists that you can think of the winner's premium as sort of like the tip of the corruption iceberg. So if you think of these winners' premium as the tip of the corruption iceberg, the majority of this tip is actually in the ward districts. We actually try and do the same analysis in close election where the margin of victory is approximately less than 5%. Again, we find very similar results. And just to say at the end that not only politicians are corrupt, but in fact, we also find certain other correlations that you would see in presence of inefficient bureaucracy. So like bureaucrats are more likely to be local in direct rule areas annexed during periods of European war, which the literature is again trying to point it out that these local bureaucrats are corrupt officials or highly connected officials with the local politicians. So lastly, to conclude, what we want to say is that, so there are three key results that we want to focus on from this work. One, investment is concentrated within state, and that investment concentration is driven by SOEs. Extractive colonial institutions can indeed explain this concentration of investment. However, the presence of pre-colonial elites can attenuate the effect of extractive institutions. So all this is to say that our work is trying to draw attention to the importance of the kind of political structure that occurred before colonization, which can potentially be interested in looking at mechanisms to improving institutional quality or thinking about why do different geographies have different paths in terms of convergence and divergence. With that, I would like to yield the stage and look forward to an interesting discussion from Francesco.
Thank you, Nishant. Thank you. Great paper. Francesco D'Acunto from Boston College is the discussant. Francesco, the floor is yours.
Thank you very much, and thanks a lot. Great, so thank you very much, Coase, for asking me to discuss this extremely interesting paper. We have about 10 minutes, so there's not enough time to say all the amazing things I would like to say in the summary of the paper. I think really it's a must read for many different reasons. I learned a lot through the paper, both in terms of institutional details as well as present-day facts about India investment. So I would like to focus my discussion on three broader points. The first one is like put into question what the authors are really doing here, which I think is an extremely important methodological contribution above and beyond the content of the paper, as well as then discuss some potentially similar sort of related channels that I would like the authors to potentially give or talk more about in their work. So first of all, there's been a very recent interest in historical data in finance and historical settings. So how are these historical data used? So the traditional way in which people were using this historical data was in what we call financial history. So the idea of financial history is that we might study an historical institution per se in itself, for instance, colonial India and what was happening in the institutions at that time. Or potentially we could try to use the historical setting to test for finance theories in order to, by analogy, learn something about the present, about the current institution or fact. Both of these older kind of uses of historical data in finance, of course, were kind of confined. I mean, sometimes were interpreted as sort of interesting curiosities, but in which the external validity was not necessarily relevant, given that they were not directly informing us on something that is matter for us for the present. So the type of work that the authors are doing instead is something that in an essay in 2019 I was labeling history and finance, which is a completely different approach of using historical setting in finance research. So the idea here is that now the current fact, the current institution becomes the important element we want to understand. In this case, for instance, how does the investment geographically distribute across India? And now we are using the history toolbox, historical colonial institutions, and so on and so forth, and economic theory in order to directly understand these new facts that is relevant to us. So in order to basically understand the deep-rooted channels that might explain the present-day facts. So this is a literature that has been, I think, growing quite fast in finance. I also have some contribution on that, some work on historical anti-Semitism, historical basic education and present investments in Europe. I really think that Srini's and Nisha's paper really fits into this group. And so I would like, ideally, the authors to emphasize a bit more why this is not just something of interest for historical reasons or for a small niche in history, really would let us understand the deep roots of channels for play. Now, let me now move on after this context to two channels that I would invite the authors to think about when considering their results. Now, the nice part of the history and finance work is that you can really exploit a lot of wealth of data in terms of persistence and channels to understand what explains the facts. And so the first channel that I think would be complementary, and I would like the authors to do a bit more analysis on, is this notion of political cycles in SOE's investment in India. Now we have this work, I think the most salient one I could think of is Alok and Iyengar in the RFS earlier this year. So what these authors find is that SOE investment in India seems to be following a very strong political cycle. Now the blue line here represents the value of SOE investment over time. The vertical line is the election year. So we can see that there is a spike of this SOE investment just before elections, potentially, as we would expect, like politicians trying to, in a sense, convince people to vote for them, and a drop of this investment after elections. So this pattern doesn't appear at all when we look instead at the red line here, which is non-SOE investment. Also, there seemed to be little substitution between the two, which is something that would be relevant in the story in the paper the author suggests. If we recall what Nish and Srini are doing, the idea here is to compare geographically areas that were exposed to different types of rulings, an indirect rule by the British Crown, which was allowing pre-colonial elites to stay in power, and direct rule, which had some kind of a difference in terms of whether this annexation happened during times of European peace. That's when local colonial elites were not deposed. And instead, those that happened during times of war in Europe, this is the most aggressive one in which the pre-colonial elites were not. And so the idea is to look at this diff and diff, what happens basically when you don't have these pre-colonial elites stayed in power relative to the other cases. Now, the idea of the paper is to think about this investment as a way for this a substitution to bribes. So the more you invest, the less you are potentially extracting in terms of those that run the institutions locally. An alternative potential way is this more kind of agency view SOE investment, which is what, for instance, Alok and Iyengar and other work take. So the idea here might be that given that local politicians pressure SOEs to invest more or less because of re-election concerns, it might be that in fact the role of pre-colonial elites, which we know from earlier work like Ayer, Totten and others, were actually directly involved also in politics after independence in 1947, it might be that actually these are exactly the people that are pushing SOEs to invest more. So it's more because of this agency view of investment. And so I think that this channel can be directly readily tested in the data. The first prediction is what the authors already show, more investment where pre-colonial elites have more influence. The second prediction would be that the SOE political investment cycle Alok and Iyengar are showing in their RFS paper actually is stronger in areas that have indirect rule and areas that were subject to direct rule and at next during times of UP. So I really encourage the authors to look into this because it could be a complementary channel. The second and last point I wanted to make in terms of the channels is what is the role, the complementarity or substitutability between culture and institution, where institution is what authors push for. For instance, in some recent work with Pulak Ghosh at IIM Bangalore and Alberto Rossi at Georgetown, high costs are cultural bias. What we look at is investment decisions by lenders to borrowers based on their cultural characteristics. So what I'm showing you in this picture, which is kind of the picture of the paper, is what is the probability that an investor of a certain religion in India chooses a borrower of the same or different religion. The black bars here represent the probability in the individual investor chooses them. The red bars instead are choices made by a robo-investing machine. So some machine which is automatic that doesn't look at the religion of the borrower when making lending decisions. And what we can see here at the very top is how likely is it that Hindu lenders choose Muslim borrowers in this setting? You can see that the black line is below the bar. So Hindu lenders are less likely to give loans to Muslim borrowers. But what happens instead is that Muslim borrowers here are much more likely to give loans to Muslim borrowers. Whereas, as I said, in the red bars, we see that the machine that doesn't obviously consider religion at all, it gives the lending similar to both. What happens to the flip side coin? Hindu lenders at the bottom here are more likely to give loans to Hindu borrowers, whereas Muslim lenders are much less likely to give loans to Hindu borrowers. So there is this kind of inter-ethnic conflict in terms of deciding who you want to invest for. And what we find in that paper is that this behavior, similarly to the work of Nish and Shoini, actually depends dramatically on variation across geography. So here I'm showing you the map of some of the states of India we are considering in the analysis for which we have data. And this is in particular, the darker is the state, the higher is the extent of Hindu-Muslim riot in the period between 2000 and 2018. Now we can see that this is actually extremely geographically especially clustered, like Gujarat, for instance, Haryana or Uttar Pradesh are states in which we have a large amount of these riots. And this declines as we go farther away from Delhi, basically. So it's lower in Maharashtra and Karnataka, very low in Kerala, for instance. It doesn't necessarily depend on where is a larger share of the population Muslim, because, for instance, in the northern states, where the population is in large proportion Muslim, the extent of conflict is actually lower than in this central north. So the idea here then that I would like also the author to push a bit more is what is the potential complementarity or substitutability between the colonial institutions and the role of culture, which is still very vivid nowadays. So perhaps pre-colonial elites might be especially effective in areas in which conflict across religions is higher because the Hindu majority actually follows their lead more. Or it could also be, of course, that these two dimensions are substitute, so it would be basically the other way around. So I think that both of these predictions are actually readily testable in the data by looking at this geographic variation, based on this variation we have in culture in the other paper. And again, I think, it would really enrich the paper if the authors had something to tell us about that. So I'm already out of time. Let me just wrap it up here. I think an excellent paper, extremely important question. And I very much look forward for more and more projects by Shoini and Nish on using this data and this type of settings, because I think that's really, very, very insightful in many dimensions. So thank you all very much again, and thanks, Jose, for asking me to discuss.
Thank you, Francesco. Great discussion. Nishant or Shohini, do you want to say a few things in response?
I think that was an excellent discussion in framing project sits within the literature, especially because both of us do a little more, we're both situated in the literature that's a little more on the banking side, so we don't have a great bird's eye view of where this paper necessarily sits in the broader realm of history and finance. I think the points that were raised about SOE investment in the political cycle, as well as interreligious, as well as inter-ethnic conflict is interesting, and those are definitely extensions that we can look at to see if the presence of pre-colonial elites exacerbates these effects or limits them in some way. So I think those are excellent points, and we'll definitely be following up on those. Thank you.
Thank you. Nishant, you want to add something, or shall we go to the other questions?
I think Shoini nailed the answer. But the only thing I wanted to add, I think, on the conflict thing, we actually did have conflict on our mind, and actually not only the Hindu-Muslim conflict, but also intercaste conflict, and that basically stems from some work by Ajay Varghese, who's a political scientist, and he's sort of talking about that there were kings, and it's been a long time since I read the paper, but let me try and recall it. So he basically talks about the Hindu kings did not like Muslims in their areas. The Hindu kings usually had a caste, and they usually favored people with their own caste. There were these areas of indirect rule where we actually see today more intercaste violence. And then we have direct rule where we see more of Hindu-Muslim violence. We looked at war and peace differences, if there are any differences between Hindu-Muslim violence. In war and peace, we don't really find any differences, and that could be due to a lot of reasons, because the way we were looking at the riots data was more at the state level, and the state level, the power of the test goes substantially lower in terms of trying to identify the differences between war and peace, because you're like doing a second cross-sectional cut of a data which is already a cut from direct. But yeah, it's like, I think that is on the next to-do list of mine, of both me and Shohini, in terms of collecting probably more micro data for violence. And if anyone has any suggestions on that data, we are open to suggestions about that.
Thank you, Nishant. Tirthankar, any questions from you or any of the panelists? You know what we'll do is to start with the panelists, and then we'll also look for questions from the attendees.
I don't think we have any questions or discussion on the panelists. No, I think there's one from Madhu. Madhu, you want to ask this question, please?
Yes.
Sorry. No, I was just saying, the latter point about the discussion, which is is it probably more lending networks rather than discrimination? Because we have similar stuff going on in US too. So is it better information networks that exist within classes of people that is making this investment possible?
Nishant, any thoughts?
Yeah, definitely. I think like maybe I went through that slide quite quickly. So what we talk about is that there is, of course, this effect coming from the great amount of social capital which these elites have. And one of the way to think about that social capital is basically through their networks, which does also include information networks. But we don't have anything more quantitative to say or try to dissect what exactly this social. So like, I think what we think of in our head in our paper is just as that. So there is this parameter of social capital, and of course it can include these information networks and other networks. But probably maybe Francesco has something to add to that thing.
Just, as a quick follow-up, given the question was about that. So unfortunately, I didn't have time. The discussion was not focusing on our paper, but actually in that paper, what we find is that first of all, so the performance of these loans is substantially lower when they are provided to people of the similar caste and a similar religion, which suggests that then these people cannot be exploiting a network, an information network in terms of soft information or monitoring. So they're not actually exploiting their information they have about people to pick the better people. They're actually doing much worse by picking those that are similar to them. And also what we find, in that work is that for these individuals, in the specific setting we have is a peer-to-peer lending platform in which lending is provided to people that are not actually close by geographically. So there is, for instance, some work by Eastman and others that looked at a very different setting, which is relationship banking by bank branches, exactly in India, by the way. And so the idea there is that if I'm in a certain community, I can choose which borrowers are the best around me better if they are part of my same religion or my same caste, because I know them better. But in our setting, this channel is completely shut down because our setting is a peer-to-peer lending platform in which, for instance, you are a lender in Delhi and you are giving money to a borrower in Kerala. So there's no likelihood to be any kind of direct knowledge or direct relationship between the two. These are definitely, I think, interesting questions that, one could see for the authors, for Nish and Shohini, how that interacts with the role of institutions, because this would be all sort of geographic variation in cultural norms.
Thank you, Francesco. Any Tirthankar, do you see any questions? Otherwise, I'm going to cold call people. Iftikhar, do you have some comments?
Well, we have a suggestion in the Q&A
Yes.
where Ajit Dayal suggests a paper on promises of investments versus actual could also be looked at, especially
Okay.
and then look at business groups and their connectivity to politicians and politics.
Okay, that's a very interesting idea. Yeah. Okay. Any other questions that you see?
No, none.
No? Then Barney Mishra might have a question. Barney, you have a question?
While Barney thinks, let me ask Nishan.
Okay, go ahead, Rama.
Do you see a variation in corruption? I guess very unusual paper, first of all, Nishant. So I'm quite out of my depth here. But do you see a big variation in corruption across the geography?
Thanks, Rama, for pointing that out. Yes, we do see variation in corruption, and I think maybe I went through the test too early because I was running out of time. So we do this test of quantifying the winner's premium. So what this test basically does is it compares the winner and the guy who came second in the race. And between two elections, we know the amount of assets that they have accumulated thanks to the RTI and the Election Commission. So we can look at how much of asset growth the winner of the previous election had between two elections relative to the assets growth that the first runner-up had. And what we find is that there is indeed an aggregate some winner's premium, which the political econ literature has talked about. And in fact, there is some geographic variation in this winner's premium. And while the aggregate winner's premium is around 3.5%, the winner's premium coming from these war districts is of the order of magnitude of 5%, whereas the winner's premium coming from indirect rule and from peace districts is of the order of around 2.5%. And when we actually go and look at very close elections where the margin of victory is like less than 5%, where you can reasonably assume that any differences in observables or unobservables between the winner and the first runner-up are likely to be very small. Over there, we find that in indirect rural areas, this winner premium is almost zero, and actually slightly negative, but we think of it as zero because of the very small magnitude. And in peace areas, we again find 2.5%, and in war, again of the magnitude of 5%.
So just a quick follow-up before I turn it over to Bunny. I assume they're all significant differences, right?
Yes.
The differences are statistically significant.
Yes, for the corruption one, when we compare war and peace, yes, they are significantly different.
Okay, let me. We have a keynote speech coming up very soon, so let me wind the session by thanking all the participants. Nishant and Shohini, wonderful paper, and Francesco. We couldn't have picked a better discussant than you. I'm just impressed at how much you know about India. Nobody can say we should have had an Indian discussant, All right. We have a great keynote speech coming up by Nouriel Roubini, who is my colleague. Nouriel is a professor of economics and international business at New York University Stern School of Business. He's also the co-founder and chairman of Roubini Independent Global Macroeconomic and Market Strategy Research Firm. Professor Roubini has extensive policy experience in addition to very broad academic credentials. He served as a senior economist for international affairs on the White House Council of Economic Advisors. He was the senior advisor to the Undersecretary for International Affairs at the U.S. Treasury from 1998 to 2000, helping to resolve the Asian and global financial crisis, among other issues. He has worked with the IMF, World Bank, and numerous other prominent institutions as a consultant. Roubini has published over 70 academic papers, theoretical, empirical, policy papers on international macro issues 2021 Global Economic Outlook. Nuriel, the floor is yours.
Hello, everyone. Thanks very much, Koz, for the kind introduction. Thanks to also the NSE for inviting me. It's a great pleasure and honor. So what I'd like to do is to do a bit of a post-mortem of this COVID recession of 2020, and then speak about what's the global economic outlook, both in advanced economies and emerging markets for the next year. Now, on the COVID recession of 2020, we know that this was the worst synchronized global recession since literally the Great Depression, not as severe as the Great Depression, but really the worst one we've had in decades. And of course, was very severe and synchronized because we needed to shut down economic activity to spread the contagion of the COVID, flatten the curve. So it was a policy-induced recession. We stopped economic activity. Initially, it started in China, then it spread to Europe, then the United States and other emerging markets. It was a combination both of a supply shock, the policy-induced shutdown of economic activity, but also once economic activity fell, there was also a demand shock. There was a collapse of employment, of income, and therefore aggregate demand fell. And that's the bad news. The good news is this was also the shortest global recession we've had. It lasted approximately 4 months, from February to March, April, and May, and by June there was the beginning of a recovery of global economic activity. And why it was so short? First of all, we reopened economic activity once the curve was flattened. Unfortunately, we reopened economic activity too fast, too soon, and we've had now second, if not third waves, but I'll discuss that. And the second reason why it was very short was that it was a massive front-loaded macroeconomic stimulus, mostly in advanced economies, less so in emerging markets that had less policy space, but there was massive monetary policy stimulus, fiscal policy stimulus, credit easing, mostly unconventional, especially in advanced economies. But some of the emerging markets with greater policy space, they also did monetary and fiscal and credit easing. Now, the question is, what's going to be the shape of the economic recovery after the recession? First of all, in the first and the second quarter of this year, the recession was literally like an eye, was a free fall of economic activity, demand, supply, employment, income, export, imports, consumption, investment, residential. It was literally like a free fall because we were shutting economic activity. Then in the third quarter, there was what looked like a V-shaped recovery because you're starting from such a low level that then even a small increase in economic activity annualized looks like big. So in the US, growth in the third quarter was about 7%, but then annualized was 33%. In Europe and other emerging markets, not as big as the United States recovery, but still, one quarter would look like a V. And many people in financial markets and research said this is going to be a V-shaped recovery because we had a policy-induced shock. I'm going to argue this is not going to be V, it's going to be more like an anemic, subpar, below trend recovery in most of the world. And if you're looking at the data for the fourth quarter, the one we're in now, it already looks like a U in most advanced economies and again, most emerging markets. And in some parts of advanced economies, we're already having a double dip recession like in Europe. Why is that the case? Why there's been a sharp slowdown? There has been a recent spread of the contagion all over the world in advanced economies and emerging markets that worsens the short-run growth outlook. COVID cases have been rising in Europe, in US, and most emerging markets, with the exception of some parts of Asia, like Vietnam, Korea, Taiwan, and so on. In Europe, this second wave is leading to renewed lockdown and to a serious risk of a double dip recession. Growth in the fourth quarter in the Eurozone is going to be negative at the annualized rate of 10%. And just right now, the ECB in its conference and statement has confirmed that we'll have a negative growth. And fourth quarter is going to be negative also in the United Kingdom and in Central Eastern Europe. And even the first quarter of the year could be close to zero, if not negative in Europe. In the US, the growth dynamic is slightly better in Europe, but given the spike in COVID cases, fourth quarter will show a massive growth slowdown relative to Q3. Maybe 2% growth in the fourth quarter at maximum versus 33% in the third quarter. And 2% annualized means barely 0.5% growth within the quarter. This assumes that there is no fiscal stimulus in the fourth quarter, as it's not going to be one, where at the end of the quarter, and there is not yet a new fiscal package. And the first quarter of the year could be also only 2% in the US, if not worse, if this fiscal stimulus is small or if it's passed late in the first quarter after Joe Biden comes to power. There are lots of red flags in the US. October retail sales were really mediocre. There has been now for several weeks a sharp rise in initial claims for unemployment benefits. Job creation in November was only 240,000 people. And now there is not yet a fiscal stimulus is needed. Now, there has been a lot of debate, but before I get to that, let's talk about emerging markets. In emerging markets, this is not just a recession. Rightly so, the World Bank is calling it a pandemic depression because the economic activity has collapsed even more than advanced economies in most emerging markets. There are about 100 million plus people in emerging markets that may be back into extreme poverty, that is defined as having an income of less than $2 per day. So it's really tragic in most emerging market economy. Why so severe? There is more density of population in emerging markets and people live in groups of large people, households or migrant workers. There are weaker health system. There is less policy space for monetary policy, fiscal and credit easing. There are many dollar liabilities. There's been a shock to remittances of migrants across the border or the income of migrants within borders. There's been a collapse of tourism income, and those who are commodity exporters had a fall in their commodity revenues because the price of many commodities have fallen. And as we know, some emerging markets have a lot of dollar debt, and some of them run twin fiscal and current account deficits. So the situation has been really terrible for most emerging markets, not all of them. Some emerging markets have better macro fundamentals, better financial fundamentals in the recovery in China, in Vietnam, in Korea, in Taiwan, and of course in some advanced economies in Asia and the Pacific, like Japan, New Zealand, Australia, has been better. But those have been exceptions. Most emerging markets are in trouble. Now some people have this debate on whether there's a trade-off between lives and livelihoods. People say if you want to save lives, we have to shut down economic activity and hurt livelihoods. And if we want to restore livelihoods, we reopen the economy, but that leads to more debts. In my view, that trade-off is misleading for two reasons. First of all, if you don't control the spread of the virus, you need to go back to sharp lockdowns, like in Europe today, that lead to repeated stop, go policies. And that's exactly what's happening in Europe. Secondly, even in places like the US, where the political appetite for a new sharp lockdown is low, the endogenous reaction of the private sector to a spike in cases, increased uncertainty, risk aversion, can be one of less spending, less consumption, less capex, less employment, and more savings of households and corporates. Therefore, we have an economic slowdown again, even if you don't impose a lockdown by the government. And in the US now we have a first wave, then a second wave in the summer, now a third wave that is worse than the first two. Even Sweden has given up on the herd immunity approach because the economic impact and the debt impact has been severe. Growth is falling, unemployment rising, and debt rates are higher than the rest of Europe in the case of Sweden. The only countries who did it well are those in Asia, some of them, China, Taiwan, Japan, Korea, Vietnam, New Zealand. Why they did it better? Because they cracked down on the spread of the virus by doing masks, social distancing, testing, tracing, tracking, and isolation of the weakest. And they did it long enough so that when they reopen, then there is not a spike in a second wave or a third wave. Now, the announcement of a vaccine is positive for the markets, but the economic effect will be positive only when it's widely distributed so that folks can return to currently risky activities like indoor dining, entertainment, sports, leisure, business, and tourism travel via airplane. So there is a gap between the time where forward-looking financial markets move and when the real economy turns around. And my worry, by the way, is that vaccines are going to be less effective than the 90% headline. A typical flu vaccine in a typical year is only 40 to 60% effective, meaning on average 50%. It's like a coin toss. And the announcements of this vaccine being 90% effective are based on really limited numbers and tracking the placebo group and the control group for only 2 weeks. And that's not sufficient to prove that their vaccines are effective. My worry, they're going to be only 50% effective at best. People are going to start not wearing masks, moving indoors, travel, and then we could have a spike of the cases again next fall and winter. So the vaccine is not a panacea, and of course, producing and distributing them to billions of people, especially in emerging market, is going to be quite challenging. So I don't think that things are going to be that easy. Moreover, there's a risk of permanent scarring, or what the economists calling hysteresis. A cyclical shock become permanent. If there is a double-dip recession or a V-shaped recovery becomes a U-shaped recovery, then over time we're going to see more permanent job losses, more business bankruptcy, less production, less capex on a more permanent basis. And moreover, in the US and many parts of the world, there is needed of deleveraging of the corporate sector that was highly leveraged both in advanced economies and emerging markets. And this deleveraging and balance sheet readjustment implies less capital spending, less employment growth, less production growth. So more of a U-shaped recovery rather than a V-shaped recovery. That's exactly what happened after the global financial crisis. The need for a balance sheet repair implied that there will be a V-shaped recovery, a U-shaped recovery rather than a V. Moreover, there is a risk of hysteresis in the labor market, because if folks become unemployed or partially employed for a long period of time, they eventually become unemployable. And millions have left the labor force already. That's why the unemployment rate has fallen officially very much. For example, in the US, the U6 definition of unemployment that includes discouraged workers who have left the labor force and partially employed workers who want to work full-time is still at 12%. And as we know, in India and many emerging markets, there is massive problems of not just unemployment, but also partial employment and severe income shock and job shock, for example, to migrant workers. The other thing I think is important is that this is what people refer to as a K-shaped recovery. There is a gap between Wall Street and Main Street. Those who have income and wealth and have jobs that are white collar are doing better. Those that are unemployed, partly employed, who are weak, who have lower income and don't have financial wealth are going down. That's the K-shaped recovery. Wall Street is big business, big bank, and big tech. Main Street is households, workers, and small and medium-sized enterprises. Millions of small businesses are going bankrupt while the market share of big business is rising. For every job created by Amazon or online e-commerce platform, there are 10 jobs lost in retail. Firms are achieving their Wall Street earnings by slashing jobs and wages and income. But your labor cost is my labor income and my consumption. So there is a risk of cannibalization of aggregate demand over time that leads you to a bad GDP level equilibrium if there is a shift of income from labor to capital, from wages to profit, from the poor to the rich. The employed and the rich are getting better because the stock market is going higher and the jobs of white collars that work from home are still stable. That's the upper leg of the K. But unemployed, partially employed, and at-risk workers are getting worse, and they don't have much financial or other wealth. So the piece of the K is going downwards. In the US, there is massive wealth inequality. 85% of equity wealth is held by the top 10%. 51% is held by the top 1%. And the bottom 50% is holding only 0.5% of the equity wealth. In the US, 50 billionaires have more wealth than the bottom 50% of the population. It is 160 million people. And after workers have been fired, like during the GFC, they are now being rehired as contractors, freelancers, gig workers, part-time workers, hourly workers, not full-time workers with contracts, with benefits, and good wages. And more of the same is happening right now after this COVID crisis. So there is the rise of what Guy Stanley called a precariat class of people that are jobless, incomeless, that are unstable, that don't have financial wealth, they are skillless, and are becoming hopeless and increasingly politically restless. As I pointed out, for many emerging markets, this is a pandemic depression, not a recession, and hundreds of millions of people are going back in extreme poverty. Even in India, when there has been a collapse through Q3 of economic activity, the growth of earnings through Q3 has been, for the listed company, plus 25%. If output falls and earnings and profits are going up by 25%, means that wages and labor income are being squeezed, if not collapsing. That's a rise of inequality that is eventually unsustainable and is socially and politically dangerous. Let me talk about the outlook for monetary and fiscal policies. Monetary policy was very accommodative and will remain so in advanced economies for a long time. We're returning to unconventional policy, zero interest rate policy, negative interest rates, quantitative easing, credit easing, forward guidance, even modern monetary theory or helicopter drop of money, as many advanced economies are effectively monetizing very large fiscal deficits. Even in some better emerging markets, about 16 of them, not only policy rates have been cut, but about a dozen of them have gone to policies of quantitative easing. Not every emerging market, but those who had low inflation and had better financial balances and smaller twin current account and fiscal deficit. Can central bank do more? Yes, but only at the margin. You can do a little more of QE or credit easing, but this has a limited effect as interest rates on the long end are already low or negative in advanced economies. Can you go more negative with the policy rates? Yes, but not much in Europe or Japan because you are close to the reversal rate. Is the movement to average inflation targeting credible? Possibly not. Fiscal policy in advanced economies have been massive stimulus. Deficits of 10%, 15, or even 20% of GDP in the US and other advanced economies. And even in some emerging markets, a bit less stimulus, automatic stabilizer have led to deficit of, say, 11% like in India. Of course, there have been also credit easing policies that are a combination of monetary and fiscal, backstopping illiquid but solvent agents so they don't go bankrupt. But how do you distinguish between illiquid and insolvent? Many business models will not survive the disruption of the COVID crisis. And of course, in many emerging markets, there is less policy space than advanced economies. Moreover, next year, we're going to have a fiscal drag globally of about 2% of GDP, as we're not going to have the repeat of the fiscal stimulus of this year. This is what happened after the global financial crisis. Fiscal drag in 2010, after the stimulus of 2009, that made the recovery of global growth a more anemic U-shaped recovery. And in the US, most likely, we're going to have divided government unless the two Senate runoffs in Georgia are won by Democrats. That implies less fiscal stimulus, less infrastructure spending, less investment for the green economy, and no tax increase if you have divided government. The markets cheer that, but that's not good for the economy. What's good for Wall Street is not necessarily good for the real economy. The economy, even in the US, is weakening as the pandemic is spreading like wildfire. We don't yet have a fiscal stimulus, and the credit facilities that were provided to the Fed by the Treasury are being phased out. And clearly, if fiscal policy is going to do less to lift economic growth and inflation, the Fed is going to have to do more. QE for longer, zero rates for longer. And globally, because of the fiscal stimulus and the collapse of output, global debt ratios are rising. The Institute for International Finance estimates that private and public debt as a share of GDP last year was 320%. This year is going to be 365%, rising, and it's going to reach in 2 years 400% of GDP. Public and private, household, corporates, and financial corporation. That leads the question of how eventually we're going to avoid unsustainable debts that lead to insolvency. And what will be the resolution? Debt monetization, inflation, or default. In many cases, it's going to be debt defaults. Now, there is an open question on whether the macro policy stimulus, monetary, fiscal, and credit leads to prevent deflation or prevent lowflation, or whether it will eventually cause inflation. In the short run, in advanced economies and in emerging markets that have low inflation, you have lowflation, if not deflation, because you have a slack in goods markets, in labor markets, in real estate and commodity markets, while at the same time you have asset reflation or inflation, given that policy rates are zero and long rates are also close to zero, if not negative. So we've seen asset reflation with a V-shaped recovery in US equity markets. Recovery in equity markets in other parts of the world is not going to be V, it's been a U, but there has been a recovery in equity markets globally, given zero policy rates. Essentially, central banks are backstopping equity markets and even credit markets, given the purchases of even corporate debt, high yield and high grade, like in Europe, in Japan, and the United States. However, I worry that over the medium term, we could see a return of inflation, or if not even stagflation, if there are negative supply shocks that hit the global economy. Those negative supply shocks include deglobalization, decoupling between US and China, and aging of population in advanced economies and some emerging markets like China, like Korea, like Russia. Compared to what happened in the 1970s, we had two negative supply shocks, oil shocks in 73 and 79, Yom Kippur War in 73, Iranian Revolution in 79, oil embargo, less growth, more inflation, and we ended up in stagflation because we're monetizing fiscal deficit. And today there is a risk of fiscal dominance rather than monetary dominance, because central banks are losing their independence in advanced economies, and given the rise of private and public debt, there is no clear exit from bloated balance sheets of central banks. And therefore, eventually, maybe inflation after debt monetization is going to be the way to prevent massive defaults. But that, again, is a capital levy on creditors and lenders. Now, other consideration, I worry that there are other problems that we'll have to face in the global economy over the next few years. One of them is deglobalization and fragmentation of the global economy and balkanization of the global supply chains and reshoring of FDI from China and Asia back to US and Europe, where cost of production are higher. And of course, restriction to immigration, given the rise of unemployment. Deglobalization, effectively, and protectionism is like a negative supply shock that reduces potential growth in the world and increases its cost of production, and eventually can lead to effectively policies of stagflation, of low growth, if not recession, and rising inflation. Connected to that, there is a rise of populism that is leading to more inward-oriented policies. Every country is trying to protect its own domestic firms and domestic workers. But if you restrict somebody's imports from other countries, my imports are somebody else's exports. And if the other country retaliates, your exports are somebody else's imports. So we could end up into trade war that becomes self-destructive of economic activity, like it happened during the Great Depression. That's a risk. And certainly authoritarian leaders are becoming more popular, both in advanced economies and even in many emerging markets. Think about Putin in Russia. Think about Orban in Hungary. Think about Erdogan in Turkey. Think about Bolsonaro in Brazil, of Duterte in the Philippines, or of Maduro in Venezuela. There is a rise in authoritarian populism that eventually is going to lead to economic policies that are not supporting of economic growth. The other big problem that we're facing globally is the rising Cold War between US and China. It's really a beginning of decoupling between US and China, first on technology, then on trade, then on financial affairs, FDI, investment, monetary issues, and so on. US and China are in a Thucydides trap, as China is a rising power and the US is a relatively declining power. And in my view, this Cold War is going to become colder, and some geopolitical strategies even worry about the risk of a conflict between US and China. There is also the risk of a conflict between China and India, as there have been military skirmishes because the border between the two countries are not settled down. So that's another negative supply shock in the global economy. We risk to live in a world in which there will be a world dominated by US and the West and its allies, and another one where China and a few of its allies, Russia, Iran, North Korea, Pakistan, and other emerging markets, are going to divide the world. Divided trade, divided technologies, divided financial affairs, divided monetary affairs. That will be a negative shock in supply terms to the global economy, creating less growth and increasing the cost of production. That's another major risk. Of course, there are other major important risks that we have to face medium term. Global climate change is going to increase economic and financial and fiscal costs. And of course, dealing with global climate change is not easy, whether you want to do it through mitigation or through adaptation or through other measures. That's a big issue. Pandemics may occur more often because now there are signs that shows that zoonotic diseases that transfer from animal and to human have to do with destruction of animal ecosystem. And as wild animals get closer to livestock and human, the zoonotic transmission becomes bigger. We had initially, decades ago, HIV, SARS, MERS, swine flu, bird flu, Zika, Ebola, now COVID-19. What if we have COVID-21? And COVID-19 has been a worse recession than any financial crisis of the last 60 years. So unless we deal with global climate change, zoonotic diseases and global pandemic may occur more frequently and more virulently and more damaging. So those are things that have to be addressed. And the other big picture is that, of course, there is technological innovation, AI, machine learning, robotic, automation. It might increase the economic pie, but it leads, first of all, to potential technological unemployment. And technological innovation is skill bias, capital intensive, and labor saving for those who have low skills or middle skills, white collars and blue collars. So if you own real and financial capital, you do well because you own the AI and the robots and the machines. If you are in the top 20% of distribution of skills and human capital, the AI and the machines make you more productive. But if you're at the bottom, 2/3 or 3/4 of the income distribution with less skills, less human capital, then your jobs, your incomes, whether blue collar or white collar, is going to be disrupted by technology. And not just for low value added jobs, but even for middle income value added jobs. Eventually, of course, the economic pie grows, but it grows in a way that is more unequal and more unfair, both in terms of income and wealth inequality. And as we know, rising income and wealth inequality leads then to social and political instability. And that's what happens. Revolts, revolution, if not civil war, it is happening in many parts of the world. That's a serious problem. But also rising income and wealth inequality leads to what Karl Marx considered the underconsumption trap, and capitalism at risk of self-destructing from within. If you have a distribution of income from labor to capital, from wages to profit, from households to corporates, we know that the marginal propensity to spend of the poor, of the households, of the worker is much higher than the marginal propensity to spend of the rich and the corporate, who have a higher savings rate and a lower consumption rate. So that redistribution of income reduces consumption, reduces aggregate demand, and then is self-destructive by itself. So both in terms of fairness, in terms of the impacts on social and political instability, and the impact even on economic growth, the issue of having to deal with inequality has to rise. Any economic policies has to be, first of all, sustainable, because otherwise we're going to destroy the planet, not just healthcare, environment-wise, but also healthcare-wise. And it also needs to be inclusive, because if it's not inclusive and there is a rise in inequality, eventually we'll have social and political instability, and we're going to have severe economic impacts that are going to have political repercussions, like even more populist and even more authoritarian leaders coming in power, both in advanced economies and emerging markets. So I worry that the markets are ahead of the real economy. There is a V-shaped recovery in many financial markets, not just the US, but other parts of the world, but there is still huge amount of fragility. The recovery is uncertain, is fragile, is going to be very asynchronous, and is going to be dispersed. Some countries are going to do better, some of them are going to do worse, some income groups are going to do better, some of them are going to be left behind, and you'll have a rise in income and wealth inequality as a consequence of this crisis, unless the economic policies address issues of inclusiveness and of sustainability. This is really the challenge that we have to face. Otherwise, this great recession is going to lead to a short-term recovery, and we could have another double-dip recession, if not a greater depression by the middle of the current decade. So this is the challenge that we're facing globally for the global economy. Maybe I'll stop here. I spoke for about 30 minutes, and I'll open it up to any Q&A. Thank you.
Thank you, Nuriel. Thank you. You've given us a lot of things to think about. So we have some time for questions, but we have to keep the questions very short. We'll start with the panelists. Tirthankar, you take over too. Okay, let's open it up some questions.
Do we have
Rama, you want to ask the first question?
What do you think, Nuriel, is the difference between the V shape? What is the key difference you have in mind between the V shape and the U shape recovery?
Well, the main difference is as follows. In terms of growth, we know that we had a severe loss of growth this year. Those who are optimistic and believe in a V-shaped recovery, like Wall Street, but even some of the official sector, believe that next year global growth is going to be well above potential. So estimates are that global growth could be, say 5 to 6%, and both in advanced economies and emerging markets, you're going to have growth well above potential. So while there's been a fall in output, some of that fall in output is going to be recovered with above trend growth, significant above trend for a year or two. If that happens, then eventually we're going to reach the pre-COVID crisis level of GDP. There is still a gap because for 2 years, this year and next year, we have lost the GDP growth that would have occurred. But if growth remains above potential, not only you go back to the same level of GDP before the crisis, but you can catch up and go back to the previous trend, and maybe potential growth is not negatively affected. In a U-shaped recovery, I think that growth next year is going to be above potential, but only slightly above potential, because of course there is a rebound, but it's not going to be significant above potential. So the gap between the trend line and the actual output is going to remain like a permanent shock. And there is even a risk of hysteresis where potential growth could be lower for advanced economies, emerging market, if those permanent scarring, both in the labor market and in terms of business bankruptcies and deleveraging, imply that potential growth after this crisis is lower than it was before the crisis. So that's what I mean by a U-shaped recovery. That's what happened after the global financial crisis. I do fear that something similar is going to happen after this crisis for a bunch of reasons I discussed. Need for deleveraging, hysteresis in the labor market, loss of human capital, risk aversion, need to rebuild savings, and the fact that I fear that the vaccines are going to be much less effective than the claim is. The claim of 90% doesn't make any sense. It's based on data that are totally, partial and massaged. We'll be lucky if these vaccines are 50% effective, like the flu vaccine, possibly less. And if people are cavalier and believe they are immune, and they're not immune, because these vaccines are going to reduce your symptoms, but they're not going to reduce your capacity to transmit the disease to other people. So if they lead to unconscious behavior where people start to travel and gather indoors and do activities that are risky, we'll have another spike, a fourth wave, worse than the second and third one by the fall and the winter of next year. That's something I really worry about.
Thank you.
If I may have a crack at the thing, Professor Rubini, you mentioned about the Thucydides trap. I mean, it was not a term many people had heard earlier, but now it's rather commonplace. Do you see far implications of this Thucydides trap going forward? You did mention that the world will be a bipolar world, but how much of a growth overhang would it have, this new way of this bipolar world?
Well, the estimate is how much of a decoupling between US and China occurs in trade, in technology, in data, in information, in FDI, in investment, in monetary affairs, and overall, even in movements of people. Now, in the US, any Chinese scholar or student is accused either of stealing stuff or potentially being a spy. Now, depends on the extent of it, how much global growth is going to be reduced. But I'll give you one example. The US, in my view, correctly says that the 5G of Huawei has a backdoor to the Chinese government, is a way of spying, and we should not rely on that one. Fair enough. But if you think about it, if you're using the one of Nokia or Ericsson, that is the European one, those ones are 30% more expensive than the one of China, and they are 20% less efficient and productive. So to build the same 5G network with the same quality in a typical US, Europe, or other economy, if you don't use the Chinese one, then it's going to cost you 50% more. So think about the implication for productivity of that. And this is just one of the examples. Now, I fear that we have no choice in the West but decoupling technologically, gradually over time from China, because China, it is not just 5G. They have a system of AI, machine learning, big data, IoT, sensor, 5G, e-commerce, surveillance, and other technologies that integrated are a system of big brother surveillance of their own society. And increasingly, that are going to go to many emerging market economy and say, you have a whole package of technology you can use, but they're going to be used for social, economic, and political control. And I'm sure that plenty of emerging markets, both authoritarian, but even some democratic or semi-democratic, like in Africa and so on, and even in Asia, are going to choose the Chinese model. But they're going to become increasingly under the economic, trade, financial, political, and geopolitical influence of China. So that's the way the world is going to be divided. And given the tensions that occur right now between, say, China and India, I think that India has realized that probably relying too much on trade and technology with China is dangerous. And there is even a decoupling, of course, between China and India on this dimension. India will have to find its own way to build both technology, trade, manufacturing, and probably build more relations with other parts of emerging markets and with the West, rather than being so reliant on business and trade only with China.
Thank you. Thank you, Professor.
Thank you.
We have a question on climate change. Do you see a renewed interest and seriousness toward climate change initiatives, Professor?
Well, I do see it, because now with Trump out and Biden in, and he has chosen a czar for global climate change, John Kerry, as cabinet level, this is going to be important in the United States. Of course, if in the US, the Democrats don't win the Senate, there are only things you can do through regulation, like we joined the Paris Accord, but spending $1 trillion on the Green New Deal is not going to be feasible. China has also made a commitment to net zero emissions by 2050 or 60, and Europe is now making a stronger commission to that. So many parts of the world are going there. Of course, many emerging markets like India are saying, you want to impose on us reduction in emissions, but you polluted the world for 200 years during the Industrial Revolution, and now you're asking us to do our share, but that's going to have a negative growth impact. So those things will have to be negotiated. How much of the effort has to be done by advanced economies, how many of them by emerging markets, whether emerging markets should be subsidized. Now, when I speak to scientists, most of them tell me that achieving the Paris Accord, the goal of 1.5 to 2% at this point is mission impossible, because the Paris Accord is a bunch of voluntary commitments, and we're already on a trajectory that's going to lead us to well above 2. So mitigation in terms of reducing emissions so that we go to the target, the 1.5 to 2% increase in Celsius temperature, looks like mission impossible. So people are now talking about adaptation and trying to reduce the economic damage coming from global climate change. But it's going to be very expensive, because many coastal areas are going to be underwater. Say in Indonesia, they want to move the capital from Jakarta, is sinking underwater somewhere else. How much that's going to cost? But what about in India or in Bangladesh or in other parts of emerging markets? If you have to move population and economic activity away from the coast, what's going to be the economic cost of that? What's going to be the fiscal cost? Can you afford it? So Mitigation looks like mission impossible. Adaptation is going to be very expensive for many people. And geoengineering solution like trying to block with dust, the solar emissions looks like, freak science for so far. And we don't know what are going to be the consequences. So everybody cares about global climate change, but I fear there's going to be a tragedy of the commons when everybody's going to free ride, nobody's going to do enough, and we're going to end up into a very ugly equilibrium. And even in India, right now, every time I go to New Delhi, and you know it very well, the pollution is even worse than, say, in Beijing, because at least the Chinese, having reached middle income status, now they start to care about the quality of growth, not just the quantity. India, being poorer, is still quite behind. But eventually, the economic damage, the health damage of not dealing with global climate change is going to be severe also in India. But of course, the GDP growth cost of reducing it significantly are also a challenge, unless there is a technological revolution that allows us to reduce emissions and having green economy and clean tech at lower cost than in the past. There are progress, green economy, clean tech, wind, solar power, other things, but we're not yet there. The trade-off between climate change and growth is still one that many emerging markets will face for a long period of time.
There is one other question on emerging markets, again, on a theme that you touched upon, Professor. What's the route out? We are shifting into a world of fiscal dominance. Central banks are seeing their options getting limited. What do emerging markets do in this scenario?
Well, if you have only limited fiscal space, and some emerging markets have more fiscal space, others like India have less, then I would say, first of all, you allow, of course, the kind of automatic stabilizer at work, and that's what India has done. There hasn't been that much of proactive additional spending. There's been automatic stabilizer. Secondly, you try to concentrate your support to the income groups that are mostly disadvantaged, the very poor, the migrant workers, those that are really at risk of being hungry and so on. Three, you try to provide credit easing and backstop to the businesses that are truly illiquid but solvent. And you want to avoid the situation where millions of small businesses become illiquid and insolvent and go bankrupt, because the economic damage and the employment damage is going to be severe. You want to help the migrant workers that are those at more at risk. And if you need to do more fiscal, probably investing into infrastructure is key. And as we know, India has a massive infrastructure gap compared to China or other emerging markets. And if this has fiscal consequences, one way of addressing the fact that you already have a budget deficit of 11% of GDP, you don't want to rise it, is by doing privatization and selling of public assets, real estate and otherwise. This is the way you're going to limit the impact on excessive buildup of public debt. So you have some space, but there has to be the right types of targeted policies that are going in the right direction, in the right places, and finance in way that don't lead to excessive buildup of public debt that eventually becomes unsustainable. So there is room for doing stuff that is intelligent.
Thank you, Professor.
Thank you.
Dr. Rubini, any view on
Yes.
the USD and what's China going to do with its large USD reserves?
With its, sorry?
With its large forex reserves. China has the world's largest USD reserves, right? Dollar reserves.
Well, I think China is getting worried that the US eventually is going to either seize or freeze or default, because in US, people talk about the Chinese virus or the one virus. And China has already started to diversify its reserves away from dollar assets. If they go into euro and yen, those currencies appreciate too much. That's a problem. If you sell dollar assets and you go into RMB, then your currency appreciates too much. They're going to allow some appreciation, but not that much. So I think they're going to diversify, first of all, into assets like gold, and gold has gone up by about 60%. There's been a correction recently by about 50% since the fall of 2018. So many of the strategic rivals of the US, China, Russia, North Korea, Iran, are realizing that sanctions, primary and secondary, and the possible seizure of dollar assets is a risk. So they're essentially building, first of all, reserves that are not dollar reserves. They're trying to create international payment systems that are not relying on dollar funding, not relying on SWIFT. They're building payment systems that are essentially based on digital payment system, Alipay, WeChat Pay. They're going to internationalize those ones. And China is going to also create a central bank digital currency. It's not going to be based on crypto or on blockchain. It's going to be all centralized, like all other central bank digital currency. But they're going to internationalize the role of the RMB and have a goal of making sure that this digital RMB becomes part of the foreign reserves of major global central banks and emerging markets over the next decade. So they have a real plan to really achieve success, not only in AI, robotic, automation, and 5G, but also in international payment system, in reserve currency, in e-commerce, and other types of services. So it's a much bigger plan than just diversifying away from dollar reserves. But that's part of it.
Professor, we have two more questions, if I may.
Yes.
One is India focus. It's by Tanab Milchandani. What's your outlook on the Indian economy in 2021? And what do you see of the income inequality situation in India going forward?
Well, like the rest of emerging market, there was a real free fall into Q2, and there has been a recovery. The recovery has been reasonably robust, but as we know, the number of unemployed and partial employed people is spiking. Profits has been rising while GDP has been falling. So income inequality has been rising. The hands of the central bank are tied because inflation is still quite high. Fiscal policy is tied because the fiscal deficit is already double digits, as I pointed out, and there is this rise in inequality. So I think that the policies have to be probably less monetary policy that's constrained by inflation, but targeted fiscal policy. Help the poor, help the migrants, help the disadvantaged, try to provide credit support and credit lines to small enterprises that are at risk of collapsing, those that are illiquid but solvent, and do a great push for infrastructure spending, but try to finance it not as much with debt, but rather with privatization of public assets, and also loosen up the regulations that limit, of course, the ability to do a lot of public investment. We know there are environmental regulations, there are land registry and use of land regulations, and over time, India will have also to gradually flexibilize its own labor market. There is a dual market where there are formal workers who have benefits and advantages, but there are way too many informal workers that are really into a much more precarious situation. But of course, those significant structural reforms are politically not very easy. And the government, has started to go in the right direction, but the speed of those reforms is too little relative to what is desirable and optimal. So a much more massive drive towards structural reforms that increase potential growth and they give economic opportunity and make the recovery and the growth sustainable and inclusive. I think those are the major challenges that India is facing.
Professor, one more question on the RCEP. What's your view on this large trade deal that has recently happened?
Well, of course, China wants to say that we are in favor of trade and globalization, when the US, the first thing that Trump did was not to join the TPP. But I think there is a very different setup between what the remaining members of the TPP did. That is a real trade agreement where lots of restrictions to trade in goods and services and issues having to do with IP, with government procurement. It is a high quality trade agreement that was done by the members of the TPP that now is a variant with it without the United States, while the RCEP is an attempt of China to do trade liberalization according to Chinese standard, where the standards are relatively low in terms of true liberalization. And therefore, RCEP is going to have some impact, but it's not going to have a huge impact in terms of trade and growth and otherwise. However, the US under Trump really had the wrong approach to Asia. Obama had a pivot to Asia because it was seeing the rise in China, but the pivot to Asia cannot be just military, sending a bunch of Marines to Australia. It has to have an economic and trading leg, and that economic and trading leg was TPP. And of course, the first thing we did in the first week was going against TPP. Of course, there are issues with TPP that US Labor and Democrats also find objectionable, but I would hope that if US wants to re-engage with Asia, if it doesn't want to lose economically in trade and financially ASEAN country, India, and otherwise, they'll have to make a new trade effort to try to re-engage economically, trade and investment, India, ASEAN countries, and those that are all over East Asia and South Asia. If there is that plan, then US, India, and all its allies all over Asia can create a true alternative to RCEP that increases trade in a way that is actually sustainable and creates more jobs and more income, and is a trade agreement that is not dominated by the interest, the rules, and regulation of China. But that effort has to be done by the United States and by its allies in Asia, and we'll see whether the Biden administration is wise enough to re-engage India and Asia in a more constructive way. We lost 4 years. We lost a lot of soft power. We bullied our allies and we called up dictators all over the world. That probably has to stop.
Thank you. Thank you, Professor.
Nouriel, I just want to close by thanking you for a really wonderful keynote, a lot of important areas covered, and thank you so much. Thank you.
Thanks to all of you. It's been a great
Thank you very much.
I hope to come back and visit this great country and democracy.
Yes, we should definitely.
Country, wonderful people. Hopefully 2021 is going to be better than 2020. Let's hope it's for the world and for India.
Tirthankar, we have to have Nouriel back in Mumbai, and you know.
Love that great city, and I love your country. So it'll be
Thank you,
when we can travel again. Thank you again.
Thank you.
Cheers. Goodbye.
Cheers. Goodbye.
Bye.
Goodbye. Okay, I think we are come to the end of the conference. Let me make a couple of concluding remarks, and then Tirthankar will also make some concluding remarks. So for me, I want to start by thanking Tirthankar, Vikram, who has taken a very keen interest, and a whole team that Tirthankar has. They are a fantastic team to work with, and they were amazing, as you know, not missing a beat. So we had a number of things. We started with the first day was Mike Kramer, who talked about investing in innovation development. A lot of interesting ideas. We had two great papers. One is empowering women, and the other was how does lending affected by border conflicts? Very interesting papers. The second day, the highlight was the panel discussion on the development of bond markets. We had Viralacharya, Anant Narayanan, Tarun Ramadurai, and Ryan Banerjee, all experts. India really has to develop its bond markets. It's a big part of the economic picture. So we learned a lot from that. And the two papers that day, again, the research papers, were about liquidity in the capital markets and government guarantees and stability. Both very important topics for India, and a wonderful panel discussion. The third day, we had Nouriel, of course, as the highlight. And we had two very interesting papers. One was IPO regulation, how it affects the speculative investors. Jay Ritter was a discussant. And then, of course, we had how colonialism and the colonial past actually affects investments in India, which is another very interesting topic. Francesco, thanks for a great discussion. Okay, so now a lot of people now know about our India initiatives. Please keep in touch with us. Remember, you're a family. So, you know, go to the NSE website, go to my website. We have a lot of information. Please stay engaged, apply for our grants. and then participate in our conferences. Tirthankar, take over.
Well, I must begin by thanking you, Cole. I mean, you're the backbone of this entire initiative, and without you, this would not have gotten off the ground. So thank you, sir. And while the conference was virtual this year, we are really, really thankful to have audience and presentation that was well beyond expectations. This is truly one of the conferences to look at in the Indian financial space. You already provided a good description of the conference course. I just wanted to thank you, and I just wanted to take the opportunity to thank Vikram Limai, our managing director and CEO, for support to the entire initiative. Really, and we are 8 years old and still going strong, and hope to have a bigger conference next year, virtual or physical. Professor Rubini would know better than any of us, and he has cautioned us, that one should not repeat the mistakes of taking the vaccine, in a cavalier sense. Very good, and personally, I just wanted to thank two people. Of course, you would agree, Ashiana from my team and Saurabh Mehta from marketing. Yes. Both have been truly instrumental in making this conference as seamless as possible.
I agree. I had some concerns about WebEx, but boy, WebEx worked just as well, if not better than Zoom. So it's all great. Yeah.
Thank you, Koz. Thank you, everyone. I mean, thanks for attending, and we look forward to hosting you next year.
And thanks for the panelists.
Thanks, everybody.
A big hand for Tirthankar, Vikram, NSE, and NYU, and Professor Koshjan from all the panelists. Come on, everyone, join me.
Thank you for coming, all of you. Thank you.
Fantastic job. It was better than I expected.
Thank you, Professor.
Thank you.
Thank you. Good night, everyone. Good night.
Good night.
Good night. Good night. Thank you, Nuriel, again.